What we're
Yeah.
contrasting here is a public bond issue versus a privately placed bond issue. And what we mean by public versus privately placed is who the bonds are offered to. In this slide, they're offered to the general public. So, you or I or our extended families could technically buy one of these bonds. And so to that end, you have a little more protections built into the system because you want to protect the ultimate purchaser of the bonds. This is one example of a transaction structure, but as you can imagine, every deal is a little bit different, and each player may or may not appear in this chart or may have a different role. But things that you'll see in every transaction are the tax certificate. And in the tax certificate, the borrower of the funds, the owner, the developer, is covenanting to comply with all of the rules and regulations required to make these bonds tax exempt. And so starting at the federal level, that means compliance with the income requirements and set-asides. And it also may mean compliance with state and local law. That's also part of the suite of requirements that may be necessary for tax exemption on the bonds required by the issuer. So that's an absolutely essential document, and the owner is required to comply with these rules for the life of the bonds, and sometimes longer depending on the structure. The regulatory agreement, similar to the tax certificate, also includes restrictions recorded against the property. So along with a deed of trust in a mortgage transaction, the regulatory agreement, and is also recorded at closing so that anybody looking on title at the project knows that this project is subject to these restrictions. So these are two key documents, and those covenants are essential to the tax exemption on the bonds. Mortgage note, I think, is pretty straightforward. Loan agreement, pretty straightforward. It evidences the loan between the borrower and the issuer. In a public bond issue, this official statement appears, and that's because that is the document by which the bonds are marketed to potential investors. So that document talks about the project, talks about the issuer. It's basically telling the story of the project so that investors have a sense of how those proceeds are eventually going to get spent.